In a recent episode of GAAP Chats, we discussed recent activity in the U.S. GAAP world, covering a few new ASUs and exposure drafts. In a subsequent episode, we provided you with insight into the latest developments in IFRS by looking at a few new pieces of guidance and some ongoing projects. In this episode, we are going to focus on the latest developments in U.S. GAAP and IFRS for the financial services industry. There's a lot to talk about, so let's get started. Welcome to GAAP Chats, the podcast dedicated to all things accounting, brought to you by GAAP Dynamics. I'm your host, Chris Brundrett, and with me today is a guest co-host, Bob Laffler. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train. Well, Bob, I introduced you as the guest co-host, but I think you're kind of becoming a regular around here.
Yeah, it seems that way with the amount of vacations and days off that you and Mike are taking. I'm kind of I think I need to get rid of guest from my title, and I also think, Chris, that it's about time that my picture somehow gets integrated into that lovely little headshot that you and Mike have.
Well, we might just have to do that. So we'll TBD, but we might update that and maybe the theme at some point in time in the future. We'll make sure to include you. I think we were trying to keep you off of the pictures, for reasons, but maybe this time we'll let that happen.
We'll have to
All
see,
right.
or I will gladly, give you back the reins of full control over this podcast, and I'll get to making some money for the company instead of all this fun games that we're playing.
Well, look, we joke about you being around a lot, but I'm actually glad you're here today because this topic, I know you've been working hard on the agendas for our US GAAP and IFRS updates for the investment management, insurance, and banking industries over the last few weeks. So, that was kind of the genesis of this episode. You and I obviously spoke and said, well, let's talk a little bit about that. We talked about US GAAP and IFRS just in general over a couple of episodes over the past month. But, let's hone in on these financial services industries, these three, and let's talk a little bit about what's going on this year in those industries and maybe what people can expect that are going to attend some of our trainings for these industries later on in the year.
That sounds good. Yeah, I've been working hard the past few weeks getting those courses together. This is the time of year when all the accountants of the world are getting through their busy seasons, coming up for air after all that hard work. And for us, it's kind of that planning time where we're actually getting things ramped up so that we can deliver training as the summer and fall months come. So yes, been very involved lately in all these special courses of ours.
Well, and I guess before we get started talking about specifics, with these industries and all the things that are going on, I just like to highlight that while GAAP Dynamics provides training for a variety of industries, as well as just general accounting and auditing training, we do have a particular fondness for the financial services industry, and more specifically, investment management, insurance, and banking. And I guess there's a few reasons for that. I mean, first, we all have experience in those industries from our days in public practice.
Yeah, that's right. I mean, we all have kind of a public accounting background. And, at least back in my day, when you started out with an accounting firm, you kind of had to choose your industry focus. And certainly for me, and I think for others in the company, financial services was kind of our business, line that we kind of went into. So, I spent a lot of time in banks and investment management, insurance companies, and then heaven forbid, when I finally left public accounting and went into industry, I went and joined and worked at a big bank, an international bank, and I was in accounting policy there. So I'll just say for me personally, it was an area where, I find it interesting. It's kind of my sweet spot, my comfort area. But also, I mean, just general accounting is so boring, Chris. You got to specialize. You got to have some, sexy transactions to deal with.
Well, and that's interesting. And by the way, before I move on, hint, hint, the bank that Bob went to work for might have been the subject of a recent podcast. So we'll see if anybody picks up on that that's listening out there. And but you're right. I mean, these industries, they do have a lot of specific accounting issues, right? I mean, they are a little bit specialized. And I worked in a lot of industries when I was in public practice, but I did spend time, I actually in insurance when I first started out, and then banking, and dabbled a little bit with investment management. But, and I learned too. I mean, it's not only the interesting issues that arise in these industries and as you called it, Bob, the sexy transactions, but each of these industries under both US GAAP and IFRS, particularly US GAAP, have very specific accounting rules. And so we do see unique accounting rules there, as well as impacts from various transactions and things like that.
And on the IFRS side, Chris, I mean, you don't necessarily have a lot of industry specific guidance, right? That's written from a more general perspective. And as a result, you end up having situations where these unique specialized transactions that you don't necessarily see in other industries, now all of a sudden we have to account for them, and we don't have special rules, and it's those practice issues. How do you apply the standards to these special transactions that's really driving our annual updates and kind of what we cover?
Yeah, absolutely. So I mean, you started to allude to it, but I guess, just for benefit of our listeners, I mean, how do you come up with those agendas? I mean, certainly if a new standard comes out that has an effect on one of these industries or is particular to one of these industries, I mean, obviously we're going to talk about that, but you mentioned, all these practice issues and things like that. I mean, how do you kind of decide what goes in and what's relevant and new and all of that?
You don't really expect me to divulge my secrets here, Chris. I mean,
Well,
the chefs don't give their special recipes out just like,
hey,
because someone asks.
this podcast is all about sharing, and it may help our listeners if they want to know what's going on. I mean, certainly they can come
Yes.
listen to one of our updates, but come on, give a little hint. Where do you get some of this good
Sure.
stuff?
So, I mean, obviously, when it comes to these, unique industries, after covering anything that's just new that obviously affects them, like you mentioned, I mean, there's always going to be new ASUs or new IFRS amendments that happen to fit within those industries, and we'll cover them. We won't waste our time on the stuff that doesn't. That's what's kind of fun about these courses is you get to what matters and you kind of ignore the stuff that doesn't. But like I said, I mean, you can't fill up an entire update course just for new standards that have been issued. There's just not that many in any given year, sometimes more than others. But I think where the fun and where the interest in these particular updates comes in is with these practice issues, and we get those by a variety of sources. But one of the easiest places to look to are just regulator findings. Right, every
Mm.
year you've got regulators like the SEC on the U.S. Side. You've got the ESMO is a big one we use for IFRS, which is a kind of a grouping of European regulators that kind of meet together.
It's the
And
it's the what, the European Securities and Markets Authority, I think. So yeah,
yes,
it's like a
that's what the
collective
ESMA
group
stands
of
for.
yeah.
Yeah, all the different, European country regulators, and of course they're trying to have some consistency in the
Mhm.
way that your IFRS is applied. So they get together and make sure they're being consistent with their enforcement. But they come out and they'll give speeches. First of all, they might have certain reports that come out of various different things that are going on. And in the case of the ESMO, one of the big things we look at there is they come out with these enforcement summaries, which basically are their extracts, they call them, of their database, and it just kind of highlights some of the things they're looking at. And inevitably, there's always going to be certain filers from the financial services industries that are dealing with some issues. So regulators is a good place to look. Another place we turn to, particularly in the investment management world, you've got some groups that kind of specialize in that industry, and a very active group for investment management is at the AICPA, the American Institute of Certified Public Accountants, since we're defining acronyms in this podcast. And they have what's called an expert panel for investment companies, right? Basically, a lot of accounting firms as well as companies in that industry space that have representatives that come together on a somewhat regular basis and bring up issues that they've been dealing with at their companies or on their audits. And they kind of discuss, hey, how would we apply US GAAP to this
Mm.
particular transaction? What's neat about them is they're kind of current issues, right? New stuff that hasn't really been looked at before. So we get those minutes and can look through them as well. And then I'd say the real secret to how we're able to come up with these topics is just the fact that we've been in this industry for a long time. We've got clients that come back to us year after year and want this training. Well, in order to get the training, sometimes you got to earn it a little bit too. So we'll go to them and say, what exactly are the issues you're dealing with? What are some of the things that you want to talk about? and they're a great source because they're kind of the people on the ground dealing with
Hmm.
the issues in real time, and we're able to kind of highlight some of the challenges that they're dealing with. So what's neat about these courses is, yes, it has some new stuff in terms of new standards, but a big chunk of these courses is application and practice issues, reminders of how things should be done, and how to deal with
Yeah.
current market and industry trends.
Well, and I think what's interesting, I mean, you mentioned the AICPA expert panel and you mentioned talking to our clients. I mean, I know many times issues that our clients are bringing up that they're dealing with in practice are also issues that are being discussed by the expert panel because those are
Yeah.
practitioners. And so we see overlap there with these emerging issues. And honestly, we see overlap between IFRS and US GAAP. I mean, while the underlying accounting rules are different and their approach to these industries is different, when it comes to unique sort of trends or transactions or things like that, things that the expert panel is discussing, for example, for US GAAP may also very much be relevant in the IFRS world. And so there's definitely a lot of sharing amongst industries with some of these issues. So thank you. I think that's kind of just a brief overview, maybe a little bit of insight into where our listeners can kind of turn if they want more information on these. But let's get into it. Let's take a little sneak peek into the agendas that you've been working on. But really, that's a highlight and a summary of what are some of the relevant real time issues for each of these industries right now. What's going on out in the world and maybe before we even dive into the specifics, right, for IM versus insurance versus banking, I mean, I'll just start out at the top. I mean, there's some general things that are going on that are applicable to all of these industries, and I guess three that just popped into my head. I mean, one would be just the overall macroeconomic conditions that we're dealing with. Tiptoeing, around, or are we going to be in a recession? Are we in a recession? Rising interest rates, struggling markets, all that. So we've got the macroeconomic conditions that are having an effect. We've got particularly in some of these industries, banking, for example, we've had some bank failures here in the U.S. We've got the ongoing war in Ukraine that certainly has an effect on all industries, but even financial services. And then we've got climate related matters, and people may be thinking, well, wait a minute, climate, what the heck? I mean, what does that have to do with financial services? But that we'll talk a little bit about it, but it really does have an impact on all industries. So I guess starting out with the first, right, macroeconomic conditions, Bob. I mean, what are you seeing there that sort of transcends all three of these?
Yeah, well, so first of all, the three that you chose, amazingly, Chris, I don't know, just came up with the top of your head, but that's exactly what the ESMA regulators came out in their report and said are their areas of focus going forward with their next round of review. So certainly because they're concerned about that, our courses will also focus on that.
Yeah.
So you and the regulators are seeing eye to
Yes, we
eye on
are.
this. So
I
that's
guess
that's
we
good
are.
for you.
Yeah.
Um, yeah, so the macroeconomic stuff there. I mean, obviously, everyone's talking about inflation. Everyone's talking about rising interest rates, in particular in the financial services realm, where you're dealing with financial instruments. Interest rates are just they affect everything, right? In the case of banking, that is probably the source of the bank failures that we've been seeing, right? As these rising interest rate environments and their lack of asset liability management. We had our podcast talking about that not too long ago. So, that's clearly an issue that you have to deal with in financial services, but it also affects your fair value. A lot of fair valuation is based on discounted cash flows. And as interest rates go up, that has a greater impact of discounting and your fair values go down. So all those industries are dealing with that. In the case of insurance, it's interesting. You don't really think about it, but inflation's really bad for a lot of PNC insurers because they have to make claims costs, right? They got to pay claims. And if the cost of things go up, well, then now all of a sudden everything is costing more. And the question is, are they pricing their premiums to coincide with the increased cost to deal with some of those losses? So we'll certainly revisit some of that. It won't be the first time we've been talking about it. This was an issue last year as well. So we'll continue to kind of just highlight some of those issues. Russia, Ukraine, this one is probably, it's a little bit different for financial services. It's more reputational risk. It's are you really, involved in this type of country and what business do you have there? But it becomes an issue when it comes to your ability to control an investment and Is it the same as before the war started in terms of the way you're running your operations if you happen to be operating in Russia or whatever, and this the general business disruption and so forth. It
Right.
affects your subsidiaries. It also affects potentially the investments you might have in companies that are operating in those
Well,
locations.
that's it. I mean, you mentioned the direct effects, but indirectly, and I'm thinking, for funds, right, and investment management, I mean, their exposure to assets, right? I mean, or investments. I mean, that's a reputational issue for them. And I know they're like a lot of other companies looking through into their portfolios and seeing what that exposure is.
And
So
it's not just who they invest in, it's who invests in them, right? If
true.
now all of a sudden you're managing money for a bunch of wealthy people who are in Russia, perhaps that's also a
Mhm.
concern in terms of your longevity and so forth. So lots of sensitive issues and certainly things that are being looked at in that industry.
Now,
The last thing
yeah, I was going to say,
go
I,
ahead.
I was shifting to ESG, right?
Oh yes, climate
Is it
related. Yes, that's the
right?
last thing you mentioned. And once again, when you look at climate related issues and ESG, I'm thinking of fossil fuel burning,
Right.
plants and destroying the environment and all that. I mean, what does that
Carbon
have to do with
credits
the
and
bank? Yeah, what does that really have to do with the financial services industry? But there's been a lot of focus there. And it is once again more of an indirect issue where, okay, well, what are you investing in to make your money? Where do
right.
you have who are you lending money to, right? Who are you providing insurance coverage to? Are you involved in companies that are considered polluters? And what's the risk factors that affect you? With ESG, the first thing that's coming out, and there's exposure drafts right now, which we'll be covering in all these courses, dealing with climate related disclosures. That's kind of the first prong of the ESG prong that a lot of the standard setters are addressing is climate. And therefore, we're looking at, what are they going to require? Is it going to be just your direct pollution? Is it your indirect pollution, upstream, downstream? So all those things are going to be looked at. And certainly, you could just see from some of the regulator findings and some of the things they came out with in their most recent report, they are looking at environmental and climate related disclosures. And if you're not providing adequate disclosures, they're going to call you out on it. So we'll be talking about not just what we've been seeing, but also these exposure drafts that are coming out and how they will impact these particular industries where we're not necessarily, I mean, if you're in that industry, you probably understand, yes, it affects us. But for the outside observer, you might say, I didn't realize that ESG was an
Mhm.
issue for these guys, but it truly is.
Well, and even outside of the disclosures that are they're working on, again, as you mentioned, focusing first on climate, but even outside of that, I mean, something we discussed a little bit last year, but investors care, I guess, and there've been some studies done. Do investors, particularly younger investors, do they have sensitivity to what they're investing in? And the answer has come back, yes, that is something that is important in their investment decisions. And so we've also seen sort of the emergence of green investments, right? And I know we talked about green bonds and blue bonds last year, but these are bonds that are specifically targeted towards clean industries or environmentally, or projects that are assisting with the environmental cleanup or what have you. So it's kind of fascinating to see how things are emerging. And as you said, like, yeah, it does affect, financial services and investment management. So, well, I mentioned investment management. Let's get into maybe some of the more specifics for each of these industries. We'll start with IM. I guess we'll look at an issue that is specific to IM, but really also potentially other industries too. And it's coming up under both US GAAP and IFRS, and this is crypto, right? And investments in cryptocurrencies. What's been going on there? I know both boards have been working on various discussions around how the accounting for crypto, but we've gone in different directions between US GAAP and IFRS. So maybe if you can tell us a little bit about what's going on in the US GAAP world as far as crypto goes, and then we can just remind folks about what's happened in the IFRS world.
Yeah, sure. So with crypto, it's interesting. We're talking in the concept of investment management. I'd say investment management's the one area where under U.S. GAAP, it's really not that big of a deal.
Mhm.
It's been fine now for a while because investment management investments are measured at fair value through earnings. So they have been doing it this way, and they will continue to do it that way. And their issues more circle around, okay, well, if I'm involved in cryptocurrency, what if I do, crypto mining, crypto staking has been a big thing recently, crypto lending. There's lots of things that you can do ancillary to just investing in cryptocurrencies, and there's been plenty of practice issues dealing with those types of issues. But they're already at least accounting for their investments in these currencies at fair value through earnings. The news, I guess, and this is something we'll talk about in banking and insurance as well, is the fact that there is this exposure draft at the FASB where they are going to hopefully go through with it and say that certain cryptocurrencies, those that actually are considered kind of marketable and more mainstream, would be accounted for at fair value through earnings, which will be a big change from the initial assessment, which is, well, they're intangible assets, they're not really financial assets, and therefore we can't really account for them that way. So now they're kind of creating its own little class of accounting, and hopefully it'll go through. It'll be fair value through earnings.
And while
Um,
investment companies, as you mentioned under US GAAP, have already been accounting for these at fair value through earnings because they account for all investments that way, there's likely going to be disclosure requirements in this. There always is,
yeah, I mean, it'll just be
and
more
that'll,
focus
yeah,
on what needs to happen, and it'll be a little bit more, hopefully, understood what's expected.
yeah.
On the IFRS side, of course, there's been talk, but that talk was actually several years ago now, where they kind of went through and said, all right, well, these types of digital assets are essentially intangible assets because they are not financial assets. They're not cash. They don't meet those definitions. And therefore, unless it's something that you're buying and selling as inventory, you end up in IS 38 and it's an intangible asset, which, of course, in the investment management world is not a very good answer. In that case, you're really not getting to show the true value of these things, and you're having to worry about impairment. But if you impair it, you can't write it back up again. And of course, there is the revaluation approach in IS 38 that might help a little bit, at least as far as getting it at fair value. But once again, the accounting is a little weird. It doesn't all flow through the P&L. So it's just not a very nice solution in the investment management world. I think people were hoping that the ISB would go the direction of the FASB and kind of come up with a fair value model for these types of assets. But at least from what I can tell, there's very little traction. My personal view is it's just not widespread and relevant enough to have them to warrant them having to come out with a new standard. They don't like to do industry specific guidance like we talked about. And if you really think about it, I mean, there's just not enough companies out there that probably have large investments in digital assets that would warrant really, having to change IS 38, come up with a new scope exception, come up with a new category of instrument and accounting for it. So IFRS, as far as I can say, is just, same old, same old. It's an
Mm.
intangible asset, which gives you some weird accounting.
So much CPE, so little time. With over 100 unique e-learning courses and even more hours of CPE available, GAAP Dynamics learning platform, The Revolution, has you covered. Do you want CPE-eligible customized training for your team with live in-person instruction or live webinars? That's cool too. You can visit our website, gapdynamics.com. That's GAP with 2 A's to learn more today. Looking for our full catalog of e-learning courses? Check out revolution.gapdynamics.com and get ready to change the way you train.
Yeah, it sure does. So, I mean, crypto, I think, very interesting, and we're going to see a lot of those sort of other little issues related to crypto. You mentioned staking and things like that as something that, again, ongoing emerging issues. But from an IM perspective, whether it be US GAAP or IFRS, is there anything else that you wanted to mention? I mean, I know we have a laundry list of, very specific issues that we're going to discuss in each of those courses. And again, a lot of them have come from these practice issues out there. But anything
Yeah,
else?
I guess, looking at this agenda, there are an awful lot of areas, and it's really a hodgepodge, I would
Mm-hmm.
say, of topics that they've been looking at. There's always going to be accounting issues associated with investments, right? And certain types of investments. So looking through here, I see there were some issues with Ukrainian sovereign bonds and when you invest in loans, and instead of having upfront fees, you have exit fees. So there'll be some interesting stuff. There's another oldie but goodie: when issued or to be announced securities and how to account for them. They revisited that topic. So lots of practice issues with investments. Fair value, of course, is always an issue that we'll be talking about, and the application of fair value. Interestingly, this year there's been a number of issues involving foreign currency. So we'll be getting into some discussion on foreign currency. Specifically, there's one dealing with ruble denominated payments and the fact that you're subject to sanctions and therefore how that gets accounted for. So there'll be some interesting little nuggets in terms of topics. And then I guess the thing that also came out, which is kind of new, it was out last year too, and we'll talk a little bit more about it, is the new ASU dealing with equity securities subject to contractual restrictions. We'll revisit that one. The fact that there is maybe some challenges in terms of restricted equity securities from a US GAAP definition versus an SEC definition. And then also the SEC has kind of come out and said, hey, the FASB's given us some guidance on transitioning. And sometimes you can't go back and retrospectively apply something because you just don't have that information. And that's probably the case with these securities. In some instances, they said, look, with your SAB 74 disclosures, when you're transitioning and so forth, make sure you provide sufficient, disclosure and materiality with regards to how you're doing it. So looks like we've got a lot of stuff, and it's going to be a question of what makes it through and what hits the cutting room floor as far as the things that we're going to be talking about. Of course, right. At the funds world, financial statement presentations, another one that always comes up, and dealing with the schedule of investments and how to account for certain things. We've got some good fair value hierarchy questions and that kind of stuff. So we got some good stuff there. I think it'll be a good course.
Well, and I think that's what's fun sometimes about courses where you don't have, a big new standard. We went through that, over the last number of years with some of these big ones that came out, financial instruments, and then outside of it, financial services, revenue recognition and leasing. But it's kind of fun when you've got lots of sort of smaller things because you could bounce around, visit different topics, kind of refresh different ones, and get into the issues. So that's pretty cool. So that's a little sort of, I guess, sneak peek, we'll say, into what's going on in the investment management industry, what we'll probably be talking about this year in our update courses. Well, shifting gears over to insurance. And this time, let's start out talking a little bit about IFRS, because that's where the big news is. IFRS 17, which is the accounting for insurance contracts, it's been out for a long time, but it's actually effective this year, which is a big deal because it's been a long time coming. The effective date got deferred, I think, several times. So it's here. And I very carefully said accounting for insurance contracts because this standard applies to any entity that has an insurance, what they define in IFRS 17 as insurance contracts. So it's not just an insurance company issue, although insurance companies certainly have insurance contracts, but others may as well. But I mean, any of our listeners that follow IFRS know this is like a pretty whole-scale change to, what we've had in the past under IFRS when it comes to insurance. I mean, this is a pretty robust standard and a robust approach versus, shall I say, a more of a goosey kind of approach under IFRS 4 that we had before. So, I don't know anything you want to mention on that. I know I've got some clients that are certainly on this, and one in particular I'm thinking about, is an audit firm, and they're dealing with issues. Some of their clients have been all over this. They've been gearing up for it. Others have kind of been, sticking their heads in the sand a little bit. And I think that's problematic because of the depth of this standard.
Yeah, I mean, it's one of those areas where I hope you've been looking at it for a number of years. It's not one of these things that you can just kind of pick it up and say, "Oh, we're adopting it this year. Let's do it." So yeah, we've been covering this for many years, and the challenge for us in our update courses, they're limited in time, of course. So you can't just, you could spend days just talking about IFRS 17 if you wanted to kind of go through the new standard, especially at the level of detail that you need to go through for an insurance company. So we've been kind of covering it for the past, at least 5 years, 6, 7 years. It's been going on for a long time, even from the days when it was an exposure draft, because it was such a big deal. We were talking about it then. Now it's really just a question of, all right, what do we want to talk about this year, and what do we want to focus on? So this is one of those areas. If we had a specific client, we would probably work with them to tailor what area of emphasis do you want to have on IFRS 17, because we could cover various different things. But what we've been noticing, a lot of questions come around different models. Like there's the general measurement model, which is the main one. Most people at this point understand what that is consists of. There might be specific issues with regards to, figuring out the right discount rate or risk adjustment or whatever it might be. But otherwise that's kind of there. Application of the premium allocation approach, the other kind of popular model for the shorter duration contracts, that's been a hot topic lately. I think a lot of people are trying to go that direction and avoid the general measurement model, and therefore a lot of PAA questions we've had, specific questions like, well, PAA and owners contracts, how do they mix together? So we're going to include that this year and kind of cover, how do owners contracts, how are they dealt with using the premium allocation approach? Reinsurance accounting is another model technically under IFRS 17 that we'll get into a little bit there on how to do reinsurance accounting. The other big thing I think that comes out of this is your financial statement presentation. The financial statements look completely different with the IFRS 17, and making sure that as someone who's new to the standard, if you have to put financial statements together, what should they look like, and what kind of information do you have to apply there? And then also, just if you're a reader of those financial statements, what are they telling us? So we'll cover presentation as well. The other thing I would say that's so important about IFRS 17, I mean, everyone's talking about, oh my gosh, IFRS 17, it's finally being adopted. I like to remind everyone that there's probably a double whammy that's going to take place, and that is you've probably been deferring the application of IFRS 9 all these years as well, because when IFRS 9 got issued, they gave insurers this opportunity to basically defer applying IFRS 9 for financial instruments because of the accounting mismatch on the asset side versus the liability side. It just wouldn't be fair. And so people took advantage of that deferral. But now you basically are in a situation where you're adopting two really big standards at the same time.
I've always wondered, Bob, if, hindsight's 2020, if the ISB would have allowed that, knowing now how long it took to get IFRS 17 effective, because they did defer it a number of times. I mean, that is a big one. And, I guess the benefit, right? I mean, the bad is the double whammy, because IFRS 9 was big, right? But the benefit is that these insurers or companies that are dealing with IFRS 17 can see how the adoption went for others, and they can benefit from that. And I know we're going to mention in a minute when we talk about banking that there's post-implementation reviews going on for IFRS 9 by the ISB. We can learn from that. So they do have that benefit of having others who have gone through it already. But yeah, that's pretty serious. So I mean,
yeah. So I mean, as you can imagine, as you can imagine, those two topics being relatively new, that will be the brunt of our IFRS insurance update, because both of those things have their issues and practice issues. And like I said, it's going to come down to what's covered, because there's too much to cover otherwise.
Right.
So we'll cover that, and then there's been also some good little regulatory findings affecting insurance companies dealing with adequate credit risk disclosures and the financial statements compliance with IFRS 7. Another interesting one that really affects the banking industry as well as the insurance industry, and really towards those macroeconomic issues that you talked about before, was you had the regulators basically, taking a note of certain filers who were reclassifying their financial assets from one business model to another, right? And it was always the same change. It was, I am in the business model of holding to collect and sell, right? That fair value through OCI category that we have under IFRS 9. And they wanted to basically say, well, given the change in liquidity, given the change of our approach, we are now going to just hold and collect and move to an amortized cost model. It's the same thing we're seeing in US GAAP, where you're getting these financial institutions basically saying we want out of fair value through OCI and we want to move to held to maturity or amortized cost. Why are they doing that? Well, it's because fair value of all these long-term investments have been going so far down that they basically want to avoid taking the
Sure.
losses in their financial statements.
Well, and I wonder, I mean, first thing that popped into my head is, wait, time out. Is that really a change in business model, or is that applying the business model of holding and selling, right? I mean, that's the whole
Yeah.
point is,
Well,
you take
and
advantage of both
what's
sides, but
of course, and of course, the other thing in IFRS 9 is that they say when you have a change in your business model, that's fine. You can change, but it's a prospective change with new investments. You don't take the old ones
right.
and
Right.
reclassify them out unless it truly is like, something is truly changed with your business, and it's such a high threshold that should really not happen that often. So as you can imagine, what the regulators found was you don't have a reason for reclassifying it and changing your accounting basis. And as a result, they've kind of taken note and had them go back and keep it the way it was. So we'll highlight that issue as
That's
well, because
that's a good one.
that seems to be throughout all financial services these days.
Well, Bob, as we are approaching the end here, we're running a little low on time. Give me the quick rundown on U.S. GAAP insurance, and a lot less going on than there is for IFRS, but at least
They're a
give
little
me
bit less, Chris, but
yeah,
the U.S. GAAP also had a new standard that dealt with long duration insurance
right,
contracts. They made what they called targeted improvements, but they were pretty big changes where we're trying to not make the wholesale changes that IFRS 17 does, but really there were certain types of insurance contracts under US GAAP, specifically your traditional life contracts, and some that are similar to that, where you had these locked in. You had your locked in assumptions, right? As far as mortality, morbidity, all these long term assumptions were locked in at inception, and you didn't have to change them. And it's not very realistic, but it was the model we used for many years. So what we'll see is this new target of improvements is getting some of those more traditional contracts to more fair value like type of accounting, where you now are able to must reevaluate those assumptions. So the discount rates is going to be something that can be adjusted. Certainly your assumptions with regards to the value of those contracts. They've also made some simplifications with the way that DAC, deferred acquisition costs, are being amortized. They've created a new kind of thing called market risk benefits, a new type of instrument. So some definite changes to be aware of that are going to have some, I would say, material impacts to an insurance company. If you're a long duration life insurance, I would say is the one that's affected most by those targeted improvements. That's coming effective this year. So that's the big one. And then, of course, same as always, there are other macroeconomic issues that we need to look at. There's other financial instrument related things that we would be looking at. When it comes to expected credit losses on your financial assets, that's always an issue. US GAAP actually has made some amendments recently, getting rid of the concept of troubled debt restructurings and requiring more disclosures on that stuff. So certainly plenty of stuff to talk about there, but like I said, besides that one long duration insurance contract amendment, not nearly the stuff that we're seeing under
right.
IFRS.
Well, thank you for that. And I guess to round it out, banking, we've already mentioned a lot of the things that are impacting banking. Certainly the macroeconomic issues, ESG, and the war in Ukraine. We talked about crypto, which affects the banking world as well. And I mentioned this IFRS from an IFRS perspective, IFRS 9 post implementation review, at least for classification and measurement for that piece of it. A lot coming out of that, and I think that'll be something that I mean, overall, I think they found that it's sound, but
yeah,
there's
that was the conclusion, that
yeah.
overall it met all its targets. It's doing what it's supposed to be doing, but there were three different areas they did decide that probably warranted some further investigation and probably amendments that we'll see coming out in the next year or two. The ones that are coming out, I guess, first and foremost, they're going to be dealing with contractually linked instruments and how to analyze the SPPI, or solely payments of principal and interest cash flow characteristics criteria for debt securities. There are two different things: the contractually linked investments and how that really jives with on the liability side versus the asset side, and some clarifications there. And then, interesting, you brought up ESG. They also mentioned ESG linked instruments. So those were the green bonds and things like that that you were talking about before. The idea is, well, wait a second. If I have somehow an ESG linked debt security that is going to change my interest rate based on whether I achieve or don't achieve certain climate related targets, can I argue that that's solely payments of principal and interest? And this idea of, well, the reason why I'm increasing my interest rate because now I'm a higher credit risk because I'm a company that now is at risk of being seen as a polluter or whatever it might be. So that has always been a judgment area, and I think that hopefully we'll get some clarification with regards to that. So that'll be interesting with that. The other thing I'll point out, there's two other areas that they might have amendments for. One is kind of, all right, whatever, it's disclosures, right? Disclosures related to, where you recognize your change in fair value, whether it's fair value through P&L or fair value in OCI. They wanted to make sure that we have adequate disclosures. You know how I am, Chris, about disclosure standards. They only interest me but so much. But the one that was caught my eye as I was going through is another amendment they want to put out there dealing with cash received via electronic transfer. And this was really interesting topic last year's update course. It was an IFRIC issue, and everybody was kind of like, excited about it. I thought it was a dumb issue. I mean, it's cash, right? Transfer of cash via electronics transfer. I mean, okay, whatever. And it did kind of make perfect sense from the asset side. The question was, if you have a receivable and you receive, cash via electronic transfer, when do you de-recognize the receivable and recognize the cash? And basically, the answer that IFRIC came up with was, well, when you have the right to use that cash, right? When it's in your account, essentially.
Right. It's actually clear.
Yeah, I mean, it was pretty obvious, I thought, but I was getting all these questions. And then I started doing some more research and seeing that a lot of accounting firms and interested parties were giving comments back to the IFRIC because this was a tentative agenda decision. And they were getting a lot of pushback. And really, the questions were more from the liability side, which is, all right, well, when do I de-recognize a liability when I'm settling it via electronic cash transfer? And this kind of brought up the banking industry, where it's like, well, when do I recognize a liability if I receive a check versus electronic transfer? Because normally, the moment you receive a check, right? Like if you're a teller at a bank and you get a paper check, well, when that check is in your possession, you recognize the liability, even though it hasn't cleared yet. Well, with electronic transfer, well, I would have to wait until it actually cleared and has been settled. So a lot of discrepancy, and it seemed like different accounting that was being applied to financial assets and liabilities. So basically, another clarification came out from the IFRIC back in October dealing with the liability side. They gave some guidance, but they said, you know what, we really probably need the ISB to deal with this. And that's one of the things that they're going to come out with is an exposure draft. And then finally, hopefully a final standard to deal with these electronic cash transfers from both an asset and a liability side. So I find it interesting that that's become such a little hot button issue.
Yeah, it's fascinating. Something that seems so trivial, right, when you first look at it, is actually a really big deal in practice. But oftentimes that's the case, and it gets interesting to start talking about these issues. And as you mentioned, I know there was a lot of discussion last year. So. Well,
yeah, and it's that's the post-implementation review for IFRS 9 classification and measurement, and right around the corner, they've already started is their post-implementation review for expected credit losses, which will be an interesting one.
That's
I think when we start getting feedback there to see if that is doing what it's supposed to and whether there's any need for further clarifications there. So, obviously, as things develop over the course of the year, a lot of times we run these courses in the fall. So, these agendas are living, breathing agendas. They kind of, change as things happen, but at least that gives you a little rundown of what we're going to be doing.
Well, thank you, Bob. I appreciate it. It's a not only sort of a highlight of what we're going to cover in our updates this year, but a sneak peek into what some of the major issues are, big issues are that are affecting each one of these industries. So, a lot going on. Again, I think we certainly didn't cover it all, but we mentioned some of the bigger, more interesting ones. So with that, I think we've rounded out our three industries. Bob, why don't you take us out?
I would be happy to, Chris. That's all for this episode of GAAP Chats, your source for all things accounting. Notes and resources from today's episode are linked in the description. And as always, you can find us online at gapdynamics.com and at gapdynamics across social media. It's never too late to become a gapologist. Head over to our website and subscribe to our blog so that you're the first to know what's new with Gap Dynamics.